Hello everyone, my name is Blake Hutchison. I'm the CEO here at Flipper, and today we're having another Flipper Masterminds. This is the second episode of a new series called Flipper Masterminds. This one, how to acquire a business with three experts. We've got Cody Sanchez from Contrarian Thinking, Sieva Kaczynski from Enduring Ventures, and James Camp from NanoFlips. All three are experts. They each have a unique take on how to buy a business, how to acquire a business, and the tips you receive today should help you on your journey to buying your first business. Thanks so much for joining.
Just like you grow out of many things, you grow out of a business and you realize your opportunity cost when you have a really big one is a lot better than when you have a really small one.
If something has been around for a given amount of time, there's a high probability that it'll continue being around for a similar amount of time.
Basic SEO, basic what I call retention tools, newsletters, or communities are not rocket science to build.
Thank you all so much for being here. Very quick introduction, if you don't mind, from each of you. And in giving that introduction, what your general philosophy is to how to acquire a business, and I guess a tip for how others can adopt it. We might start with James, if that is okay.
Serial entrepreneur, college dropout, internet kid, that sort of classic cliche of a human. My tagline I like to say is like 2 exits, 1,000 failures. And it's really just because I'm constantly trying new things that don't work. And I realized that the things that had the highest likelihood of working were me sort of acquiring things that already had traction. And so my sort of philosophy is that most people fail going from 0 to 1, and it's much easier to acquire something that is already at 1. Sold a small ad network when I was young, sold a portfolio of content sites a couple years ago, acquired a DTC brand last year in the hearing aid space, and we just sold that about 2 months ago. And now I help people try and find and acquire what we call lower middle markets online businesses. It's sort of like sub $5 million online businesses is sort of the space that I play in.
Yep, and the space that 99.9% of people are in. So pretty good space to be in, I would have thought. How about we go to Cody?
Cody Sanchez, founder of Contrarian Thinking. I have most of my career was spent in private equity doing the things that most people don't like when it comes to business buying. Also did some stint in public markets and in venture capital. And then sort of one day realized I wanted to do it all for myself and not for a big firm. And so I started buying up assets that I didn't realize other people found interesting, like laundromats, car washes, landscaping companies, roofers, pool companies, like Sieva has too. And then we built sort of an audience around these 27 now businesses that we have that I call boring businesses that cash flow. And so now there's about 2 million people that all follow along to Contrarian Thinking, talking about different ways to think critically and cash flow unconventionally. And the crazy part is, I think this all happened at this beautiful moment in which we're having sort of these three waves collide. You know, the gray wave of retirees, the great resignation of millennials, and sort of the great corporatization, let's say, where more and more things are becoming the Walmarts and less things are becoming the neighborhood corner store. And so this conglomeration of the three things happening at once has led to 50 million people a month watching our stuff.
That is very cool, and probably not quite as cool as me splashing the entire computer screen with a bottle of sparkling water. So for the audience out there, hopefully you just got a good shot of Wet and Wild playing out here live. Assuming you can all still hear me, Sieva, over to you.
Hey, my name is Sieva. I run a business called Enduring Ventures. It's a long-term holding company. So we buy durable businesses at fair prices, oftentimes from retiring owners or sometimes from owners that just want to sell their asset and stick around. And we hold them forever. We're not private equity. We aren't looking for ways to kind of fix and flip or sell our businesses a few years later. We just want to own a portfolio of these beautiful businesses. By background, I was an entrepreneur most of my life. So I've started a few businesses. Most recently had a network of clinical research sites that I built and sold. Spent some time in venture capital. and was recently inspired by Cody to start posting our adventures on Twitter. And it's been incredible. It's been really interesting to share our journey and see how people respond.
We recently filmed someone who was a customer of Flipper, and they said buying on Flipper was a little more effective than their MBA. And I can tell you, consuming the content of James, Cody, and Sieva will take you a long way. So start there. We'll obviously share their resources as part of this session. Sieva, one of the things you just said was, first and foremost, the firm is called Enduring Ventures, and you said that the whole idea is to hold forever. Can we just talk a little bit about this quickly? Because, James, you've obviously set businesses up. I'm not necessarily sure whether you set them up to exit, whether that was the actual frame from within which you built. And Cody, you're buying these so-called boring businesses, which actually look damn exciting when you present them, I must say. But can we just talk about the philosophy around buying something to either exit, so you actually start to exit, or you acquire to grow and exit, or the approach that Sieva's taking? Who can provide me a perspective on that?
I'll give you a quick sort of recap of the way I look at things, and it's more just a function of that my ADD is so strong, right? And I think that I really don't have more than 3 to 5 years of anything in me, and really that was a hindrance when I was younger. But as you get older, it's the time flies by faster, and it makes sense. Candidly, when I started talking about flipping websites all the time, it's partially because you're sort of at the whim of algorithms online, and sort of things change and things can move so quickly. I find it's important to sort of think about how you might get out of that. But really interestingly is that when I talk about flipping, it's often sort of a tactic to sort of bring in people to the concept of how to change enterprise value of a business by changing its cash flows, right? And so I think that in general, what I find is that often the people that I talk to that do best don't buy websites with the plan of a flip necessarily immediately, but they start understanding that is the tactic that brings them into understanding this opportunity that exists today. And there's an old saying, which is everyone exits every business. There's never been a business, that's never been exited ever. So at some point, there's going to be an exit, whether you die, whether the business goes out of business, or whether you sell it to somebody else. At some point, the business is going to be gone out of your hands. And so for me, my shtick has really been about trying to show people that they don't come from Cody's world, right, of private equity, and that a lot of these tenets, a lot of these concepts that value-added PE firms work under can actually, I think, be applicable to smaller businesses. So for me, I do think about an exit. I think flip sounds, it's too sad. It's sad I named everything nano flips. It sounds cheap when you think about flipping things. But hypothetically, I do think about sort of how to get in and out of things just because of my attention span, pretty candidly.
Yeah, and there's also a global network of buyers who will take something off your hands. So it is natural to think in the context of an exit. Cody, these businesses, these 26 businesses that you've acquired, as well as the advice that you're providing every day to people, is it provided from that perspective that one day you will possibly exit?
It's more about the idea that, twofold. The idea, first of all, that you create a portfolio of equities, which is how most people guarantee their financial freedom long-term in the future through, let's say, public equities. And I do not think that most people think about portfolio compilation or portfolio construction when it comes to private enterprises as an individual. And I think that that's a huge mistake. There's, a big group of people out there that talk about passive income and having varying levels of passive income, but not very many people think, how could I have a grouping of assets that perform differently in different markets, because the world is more and more volatile. And this would allow me some ability to sleep at night by having something that performs well when the market goes up and something that performs well when the market goes down. And so given sort of my public markets background and then private equity, I just thought of everything as a portfolio. I was like, I just don't know. I do not know which company long-term is going to win or lose. And I don't think anybody really does. And so I want to have some sort of hedge on my bets. Yeah. And I think where most people screw up is they actually believe that the people, like maybe the four of us on a call, are normal, and we're a mixture of lucky and chance and hard work and whatever. But most people don't actually make it past their first million in a business. And so, I always go at it with one friend of mine who doesn't believe in multiple income streams, but I think you're crazy to not understand that survivorship is real. So I like to hold these businesses for a long time. I err more towards Sieva's side, and that I hold them for a long time. But sometimes, just like you grow out of many things, you grow out of a business and you realize your opportunity cost when you have a really big one is a lot better than when you have a really small one. And so then I will sell businesses or merge them or give them to some of the founders or operators who run the businesses. And that's sort of how I think about it. And
Sieva, is that exactly what's happening for you? You're finding that these businesses, if you've acquired, you do so with the intent of holding forever, but depending on what happens with the business, depending on the nature of each business, you may obviously consolidate within the portfolio and or potentially exit if the opportunity was there.
Yeah, we really don't think about exit at all in our business. Even if a business is too small or maybe distracting, I think we just think about holding it forever. It may be one of my faults. I just don't like to sell things. I've never liked to sell public stocks. I'll just buy things and hold them forever. I think Enduring Ventures is well structured for me because I don't ever want to give anything away.
I mean, without getting into the macroeconomics too much, let's just summarize it by saying there's geopolitical pressure, there's inflationary pressure, there's stock market downgrades, there's all of that stuff that we've all read about. It's a strange market. But what does that mean for small business M&A? So what does it mean to think about acquiring a business when everyone else who's hyper-conservative would say, why would you do that right now?
I think in our segment of the industry, you mostly look at small businesses, right? And we're mostly looking at like small, boring, kind of required businesses. And what I mean by that is we own a plumbing business. We own a business that provides internet to people's homes. And those are two services that no matter what happens to the economy, if you have a leak in your home, you're always going to call the plumber and you're going to pay whatever it takes to get that plumbing fix. And if the internet has gone out at your home, as I'm sure it has before, that your whole family's in a panic until it gets solved. So we're in a lot of businesses that aren't really affected by the kind of macro economy. One thing we do think about quite a bit is, do we have pricing power in the business? If there's inflation and the cost of our supply and the cost of our labor goes up, are we able to pass through some or all of that to our consumers? So that for us happens in the business buying process, because we know, and this is to your previous question, we know if we're going to own a business for 30 or 40 years, we're going to hit recessions. We're going to hit inflationary situations. Mm-hmm. So we just need to buy businesses that can withstand those outcomes and come out stronger on the other side. So that's how we think about the world in this.
And it makes sense as well, because those businesses presumably weren't overvalued to begin with either. So not only are they recession proof, it's not like you ever were considering them in a bull versus bear market. They've just always been a bit bearish.
Yeah, and that's why we're a little bit shy around software purchases, because the multiples can be pretty high and the multiples can be based on revenue. We always want to buy off of a clean multiple of cash flow, because we know, a few years later, we're most likely to be in the money.
Cody, clean multiple of cash flow. How do you think about these boring businesses and their values and how you go about acquiring them?
One, I don't buy dreams, I buy realities, which is similar to Sieva. I buy businesses that are profitable today, and I buy them for a multiple of their profits. Yeah. Then we have an overlay model, of course, like everybody does, that shows if we make 100K today and we make these 5 changes, I think we could turn it into 500K. But I don't tell the seller that. I buy it based off that 100K number, and then the 500K is all my sweat and equity, or my operator's sweat and equity that they have to pour into it, or additional capital. And so we have a framework called SOWs, which basically is the type of business that we like to buy, which means it's stale. So it's an old business. There's some sort of market that's been there for a long time. It's in a market like, let's say, plumbing, that doesn't have a lot of innovation inside of it. It is actually old, and that it has at least 3 to 5 years of financials that we can associate with it. It has some sort of weak competition, meaning, like, I don't think anybody ever calls and brags about their plumber and how amazing the service was, and then they did this great model and follow up and they got you on a subscription. That's like not typically going to happen. And then it's simple. So, I don't try to pretend that I'm smarter than I am. If I can't understand the business, I'm going to pass on it. And so I use that model sort of continuously to make sure that I'm not buying other people's dreams, which means in a downturn like the market is at today, I probably have protected myself enough on the buy and with this type of business that there's more upside than the market could take on the downside.
I think it's super spot on what you said. One of the principles Cody mentioned is longevity, right? And that's something we think about a lot. And there's something that an effect that people talk about called the Lindy effect. And the very basic kind of rudimentary premise around that is, if something has been around for a given amount of time, there's a high probability that it'll continue being around for a similar amount of time. So what I mean is, when we look at a plumbing business that's been around for 15 years, we know that it's withstanded multiple recessions, all types of competition and issues. And we can be comfortable buying the asset, knowing that, hey, as long as we don't mess anything up and we have good leadership and we treat the team well, it's most likely that this business isn't going to fall apart after a year or two. It's probably going to be around for the next 10 to 15 years.
Yeah, that's a really, really critical point. We say that a lot. It's also the same reason turnarounds are hard, right? If something's decreasing 10% month on month every month, the likelihood is, no matter how good you are as an operator, it's still going to be decreasing 10%. So really good point. The other thing, James, that Cody just alluded to before was the understanding you have of the business. Here at Flipper, so many people say, I want to buy SaaS, I want to buy SaaS, I want to buy SaaS, because it's the sexiest term in software. But the reality is SaaS is difficult. A lot of people don't understand the unit economics that go into a SaaS business. You're sort of helping people do it a simpler way, going after content sites.
Sure.
How do you think about that comment of, buy what you know?
Well, I think what's interesting is that I personally, like, what I sort of preach to people is it's not different in the way I live my life, but I've bought e-commerce businesses, right? Like, I just have an experience in that world. Like, I understand that. But when sort of most people that are really interested in this concept come to me and ask if they want to buy an online business, what business would they look at? I always push them towards content sites, because it's the least moving parts. You're making money through normally affiliate ads or display advertising, which means that your back end, although you make less money per that click or per that impression, your entire back end is owned by somebody else, right? So you're getting paid to basically be a middleman, right, in that scenario, versus a software company or an e-commerce brand where you actually own that entire back end. You need to monetize that customer, right? So owning a niche content site, or affiliate blog, or however you want to look at it, you are hypothetically, the only reason that someone's buying an ad placement on that site is because they're arbing that click for more money on the back of themselves, but they are the one who's worrying about LTV, right? Worrying about the lifetime value of that customer. Whereas you have to worry about literally driving people to that website. That's the only thing you have to worry about. So when I think about, like, in general, a lot of these blogs aren't super high expertise things. These are things that are essentially a bridge of information for people, right? So someone says, what is the best headphones in Google? Well, there has to be a Google result that comes up, right? And that's someone's website. And you are that bridge that then connects the people to the advertisers, that connects people to those products. So that's why I really think that most people that are sub 500K and sort of looking for a part-time or side investments sort of can play in. When it comes to looking at these businesses, I sort of also abide by the Lindy effect, even though, with that said, it's a little bit more short-term in this. So in my space, debt is much more complex than I think in the space the two of them play in, right? It's just much more rare. There's very few people that will underwrite these loans. It's a lot of like 401k loans that you can do. There's a couple e-commerce lending platforms that are SBA, but in general, lenders are going to want 3 years of financials anyway, right? So if they're hypothetically coming in. So for me, when I tell people to look at businesses, I tell them to sort of underwrite them and look at them as if they were playing with somebody else's money, right? So has this business been around for 2 or 3 years? are you comfortable with the mechanics of what's going inside of it? And so basic SEO, basic what I call retention tools, newsletters or communities are not rocket science to build. Now, with that said, you're not going to get the magic of that SBA 7A loan at a 10-to-1 leverage, right? Like that's just not going to happen. But you are probably going to be able to play in a space where you can actually do something with $20,000 and sort of get your hands dirty as you go. So that's sort of like how I look at it.
Age is a really important thing, that predictability of an asset. So the average asset sold on Flipper is actually 4.5 years old. Most people don't know that. And it's for the exact same reason. Savvy buyers, similar to you three, adopt a very similar approach. Can we talk a little bit about how you discover and find your deals? Because there's so many places out there right now. And then what is the list? What is the checklist you follow to assess whether you move to that next stage? No doubt it's a little bit nuanced for each of you. I might just go top right to left again. Sieva, how do you find your deals?
Sure. Yeah. So two big segments we can cover here. But as far as finding our deals is concerned, it's really broken down between three sources. The first one is brokers. There's just tons of folks out there whose job it is to find businesses that are for sale, prepare them, and market them. So about a third or maybe a quarter of our deals is brought to us through brokers, people that know what we're looking for, people that know what we want to buy and how much we want to pay for it. Another third is from direct outbound. So that means we know we like an industry, we find a business that we really appreciate from afar, and we'll reach out to the owner and see if maybe they're open to sell.
Yeah.
And the last third is really just through our online presence. We get a lot of inbound through Twitter and our website, folks that identify with our long-term hold concept. I think a lot of owners like that. They know if they sell their business to us, we're going to carry on their legacy. So we get a good number of folks reaching out in that way too.
And as soon as you receive a deal from a broker or through your direct outreach efforts, what are the things that you quickly look at to assess whether you go to that next stage?
So we're looking at revenue to cash flow because we're cash flow buyers, right? If that number percentage is quite high, then it's worth a second look for us. We're looking for businesses that we think are durable. If you fast forward the clock 20 years from now, do you think this business is going to be around from now? Is still going to be around or not? Like we own a swimming pool construction business. I'm fairly confident people are going to like swimming pools for a long time. It's a good example of it. And another one is price. We get a lot of folks reaching out to us, just want to tell us about their business, want to figure out what we're going to pay for it. But to us, that's an indicator that the owner's not quite ready to sell yet. So when we hear from an owner, when we hear from a broker, we want to know what is the price that we're going to pay so we can make a quick decision around whether it's the right decision for us.
So for everyone out there listening, Sieva's tips around how they find businesses, but then how they assess businesses are absolutely something that you can do also. It doesn't matter the size of the business. That approach is very much applicable for all. Cody, what is the approach that you and or your team follows?
When I first started, I was pretty old school. I would go community-based. It was located in my local area, especially in Phoenix, Arizona, where my parents are. My dad's really connected in the community. And so, a lot of those first businesses were from people that we knew. And I actually think that's the right way to go to start if you're going to go with hard asset businesses, because the best deals in hard asset land are usually the ones that are off market, right? And they're usually the ones where you actually have some transfer of trust and where, you understand the local community. And so that was how I first did it. It was pounding the pavement, community-based, hand-to-hand combat with local owners in a community that I cared about, I knew, and I wanted to add value to. And then as I got bigger and started traveling all around, that changed. It was no longer really feasible for me to buy businesses. I was often, when I was really aggressively buying businesses at the beginning, I was working in Latin America and I wanted to buy in the US. And so I really couldn't even be locally based in order to do that. And so then my method had to switch. And I went to really finding first operators, which I know Sieva does a lot of this too. I would find an operator for a business that I knew I wanted to run something with. And that operator would often bring me a business in the same space. So it wouldn't be like, head of a plumbing, division then brought me a laundromat company, although maybe that could work. It would be sort of hand to hand. I want to go and run this actual type of business, and I want to do it with you. And so a lot of the operators I would pick my operator first, and then I would pick my business, because I truly believe every business is a people-based business for the most part, once you get to any sort of scale that's passed to you. And then the third way that I do it now has been really purely push instead of pull. So I've gotten lazy as I've gotten a little bit older, and it's content based. So I want people to push me deals all the time. I don't want to have to pull them out of dark corners. Yeah. And so, with content, people are pushing us deals all the time. And now we just have to get smart on how we screen them. And so where I spend most of my time and my team is just looking through a ton of deals, because most of them I won't say they're not good. They're not good for me. And so I have to figure that out. But I think, the biggest mistake that I think people make when they're searching for businesses, and it's a general thing, like I highlighted this business this week that I want to invest in. And their social media person pinged me and was like, hey, we're not taking investors right now. So can you update the content that you've put out that just got 1 million views to tell people that we're not taking investors right now? And I was like, you should be fired. Let me talk to the CEO immediately. That is the worst response of all time. What you should be saying is, thank you, type form, email grab. And the second that we need investors, here we go. And so that's exactly what I do. I take all the deals, we categorize them. And, at some point in time, maybe we need $100,000 tuck-in to an XYZ company that even right now, maybe that's not my target market. So I'm never like, don't send me deals. And plenty of people say that on Twitter. They say like, don't send me deals. They're not my target market. I'm like, I'll send them all, but they'll go into this black hole and I'll call you if I need you.
It's a pretty good tip. I would be shocked at how many buyers we get who say this isn't right for me now, but they come back 6 months later and say I've changed my buyer mandate, and they should have been creating all sorts of alerts and watch lists that just inform them and help them understand something before they move into that space. Thank you for that. James, what are you telling this community around how to find deals?
Well, first of all, I think it's funny because I come from such a different background than Cody, and I love that basically you're running like a search fund model where like you're finding the operator first and then finding the entity for them to run, and that's like super cool and obviously very different than I run things. But I think the way that I tell people to look at stuff is quick anecdote. In 2020, I bought a house. I'd never owned a house ever. I sold this company and I thought, I'm going to become a real estate investor. This is what you do when you have money. You buy homes, right? And so I bought a house, sight unseen, wired off the money, and was like, now I got this figured out. I knew nothing about the neighborhood. I knew nothing about the house. It was maybe the toughest thing I've ever done in my entire life was run out of that house. But so what I tell people is when they want to go buy an online business, they need to start thinking about it like they're going to buy a house, right? So like if you were going to move into a neighborhood, you would go look at comps in the neighborhood. You would look at what had sold. You would look at what the price per square foot looked like. You would look at sort of how does the neighborhood look? So the first thing I tell people to do is really just start looking around, right? Like think about what your criteria looks like of what you're interested in buying, what your budget is, what is the niche that you think you can work in, and then sort of go look around at things that have already sold in that space, right? What are they selling for? Why are they selling at that price, right? What did the seller give the buyer? Did they give support? Did it come with a keyword list? What did it come with, right? I think those are important things to look at. And then I say, walk the neighborhood, walk the area, see what it looks like. And then the other side of it is to actually start to treat this seriously, right? And so like to create like an investment memorandum, right? Like what does this look like for you? Like if you were really to buy this business, what are the holes it has? What do you think it's going to cash flow? What do you think you can improve? And put it all together and treat it as if you were using somebody else's money, right? Because I think people get really sort of gung-ho really quickly and don't recognize that there's a lot of pitfalls. The last thing I'll say is that I hate to say this because just like Cody, I get so much deal flow because everyone knows that I play in this space now that it's almost, I don't have to go looking for it so much, right? But in general, you take places like marketplaces like Flippa, sort of it's important to think about what you're interested in beforehand, because I think it can be overwhelming to a buyer that doesn't know, right? You go and there's tens of thousands of websites for sale. Well, start thinking about, what does your budget actually look like? What is the time commitment you think you can commit to? What is the niche you're looking for? And then what I tell people is that they should move very slowly and then very fast. And what I mean by that is, like, figure out what you want to buy and wait for it, right? It's not, what happens is people read my content, read all of our content, and think this is so easy, I can just do this with anything. And then they end up just buying a crappy deal. I mean, one of the best things that I could tell people, it sounds so cliche, but if it looks too good to be true, it probably is too good to be true, right? And so I can tell you that certain types of online businesses sell for, X multiples of cash flow. And if it's selling for below that, there's probably something a little sketchy about it. And that's just because this nascent industry is actually mature enough that there's enough buyers in here now that nothing is selling for, I think I've told you the story, Blake, but I remember I posted like 15 years ago, I sold the website, and I told everyone on this forum I used to be a moderator on, I had this website, we made $500 a month. I just sold it for $5,000. Guess what, you guys? If you make $500 a month, you can get 10 times your monthly net revenue. And that was like normal, right? That was sort of mind blowing. And now that multiple, I think, is really in like the 3 to 5 year range, sort of in the space that I play in. And even then at a 5X, that's like a 20% cash on cash return unlevered. It's sort of like obscene returns, right? Like, so I think people were a little disillusioned by the past couple of years in crypto and equities markets, and just sort of what they think returns should look like. And now that things are coming down to earth, that the three of us and the way we look at business, which is buying cash flow positive businesses at sort of, based on fundamentals and reasonable valuations, like, these are still obscenely good returns in the scheme of things. I tell people all the time, you want 6% dividend yield, you want like true passive income. There's AT&T's been doing that for 30 years straight. It's like, but semi-passive income or finding an operator to run these businesses, like the two of these people do, like, that's, if you want to get 20% of your money, there has to be some sort of involvement by someone, right? It is not just going to just hit your bank account quarterly as a dividend. So yeah, that was a little tangential. No,
that's fantastic. So be patient, wait for deals to come to you that make absolute sense to you, that are similar or identical to what your mandate is. The other thing is, don't blow your entire budget. Take a portfolio approach. So divvy it up among X number of businesses, hedge your bets a little bit. Really, really important tips. Thank you. Now, what about valuing a business, right? Now, of course, different businesses, clearly your HVAC businesses, Sieva, are going to be different to buying a digital asset. But generally speaking, I've got a couple of questions here that relate to how we put a price on a business. I'm going to start with IP. My general view is that in small business land, very different to big business land, in small business land, IP isn't adding a huge amount of incremental value to the business. Agree or disagree?
Yeah, definitely agree.
Definitely agree. So everyone always comes to Flipper and they're like, I've been around for 3.5 years. I'm doing $50,000 in monthly revenue, and I want to sell for a couple of $1 million because I've got all this IP. And the IP isn't exactly IP anyway, but they define it as being such. And we've just cleared up today that in small business land, it very rarely adds a huge amount of value. Does anyone want to add anything to that, or I can move on to patents?
IP in the sense of brand or brand value over time will start adding dollars to the valuation. So, for us, we look for a variety of different moats. When we buy a business like an HVAC business, it's a local business, but we are looking for its local brand. We are looking for its local brand recognition and its strength, because for that, it means that we're going to get free customers, quote unquote, free, right? Folks who are coming our way because they're familiar with our brand. They're familiar with the brand equity. So we do look for that in some sense. But maybe it's not the traditional IP sense that we think about when we think of large software companies or a large brand like Coca-Cola, for example.
Okay.
I totally agree. The only thing that I would add is, if you're a seller and let's say you have an Instagram account with 100,000 followers, let's say, because then you could say there is some inherent IP in that. I think you just would want to think about, if you're going to list on somewhere like Flippa, you'd want to list based off of your profits or revenue, is my opinion. And then I think you could unlock the additional IP by saying, we can do X and Y and Z. And if we hit these metrics with our X number of followers, or with our brand and notoriety, or by helping you actually close these big accounts that we do say are here because, X, Y, then I think you could do it in earnouts and upside. But yeah, for the most part, I'm definitely not buying any IP for any of the businesses. And then you also have to think about the tax complications for that. I mean, for your buyer, we're going to want to have as many things listed as assets as possible, just from a tax standpoint. And simultaneously, the S&P 500 is now comprised of a predominance of actually intangibles, things like IP. But when you look at the small business landscape, IP is not protectable in a small business. You don't actually have intellectual property unless you have protections around it in some way, shape, or form. The only thing that I would add, though, is systems, processes, and things that make the transition easier for a buyer. Those could actually be worth more than your quote unquote IP. So if you hand me the playbook for every single thing that you do more than 3 times, that has more than 3 steps, and it's outlined beautifully, I might actually pay more for that business than the same business with the same profits.
Fantastic. What about how you think about valuation for these various entities that you are considering, in considering things like transferability, growth potential, diversity of revenue streams versus a single revenue stream, even competition? Do you like more competition versus less competition? How do you think about valuing a company, I suppose, in general to begin with?
When I was a young lad, I had dreams of building multi-billion-dollar companies. That is so far beyond gone of what I'm interested in doing these days. And so for me, I don't think about businesses that have no competition, because I just think that the likelihood of me winning in a space where there are no competitors is just very, very low, right? So I'm interested in sort of businesses, online businesses that I can just take a tiny slice. And I know this is like a big no-no in capital raising, is like talking about like, if we can just take, 1% of the TAM, I know that's like the worst thing. You never want to say that, but in general, I do think I want a healthy market. I want something where I know there's demand, right? And so I think for me, and probably for local businesses that the two of them are speaking about a lot, is it's not necessarily that I have to be a differentiator by being better in a competition. Is I need to be in front of your face, right? And when I talk about like websites or communities or newsletters, it is not as if it's not zero sum, right? People don't read one website. People don't read one newsletter. People don't be part of one community. Like you can read 4 newsletters or go to 4 different websites when looking for information, at least in the content site space. So I enjoy sort of things where, evergreen niches that seem to be rising TAMs, right? Like I'm interested in things that I think we could talk about, like GPUs and chips, right? Like this sort of space is something that's going to continue to grow as long as you believe that the future continues as we know it. We'll be fine. And I would stay away from like steam engines. That's a horrific example, but you get my point. Like things that are like just going to the wayside. And so, but that's like super macro, right? For me, like I just want like, is Google Trends is a great opportunity, I think, for people to look at sort of, are people looking for this content? Is this something that people are interested in? Is it continuing to go up, and has it been around for a while before? But so yeah, I like competition. Since I'm not trying to be a market leader, like that's not a huge issue for me. Competition is probably fantastic.
Yeah, I agree with that. I think competition is fantastic. Although what I would say is in the hyper competitive spaces, let's say you're buying into the Amazon FBA space. If you can find a top 5 retailer within a couple of thousand strong market size, you're really defensible in that position, because Amazon will always favor the top of the pyramid. So I think competition is great so long as you're near the top. Any perspective around how you value a business other than, of course, cash flow? What else adds material value to an asset?
I think first and foremost on valuation, we want an owner who's thought a little bit about what their business should be worth, talk to some owners, and comes to us with kind of a price range. Because oftentimes it's a new market for us and they've been in it for 15, 20 years. They have a much better idea of how businesses should be valued there. So that's really where the conversation starts for us. After that, generally speaking, we buy businesses anywhere between 2.5 times yearly cash flow up to 5 times yearly cash flow. We've stretched a little bit sometimes, depending on the business. And things that we're valuing are really the scale, right? So if we're buying a business that has 500,000 of cash flow, it may be on the lower side of our valuation range. And the reason is just that a smaller business is going to have less infrastructure, less systems, a smaller team. Whereas if you buy a business with 3 million of cash flow, that may be priced higher, because what we're expecting is that there's a team, there's a management structure, maybe there's a brand, maybe there's systems and processes, and they've been doing it for a little while at a more meaningful scale. Other than that, we're looking for durability, right? And there's two different versions of what we look at. We either look at something that's recession resistant, or it's durable, right? Or both. So recession resistant means like if there's a dip, which we expect there will be over some given amount of time, will people keep paying for this? And the examples there are like the plumbing business and the broadband business. Yeah. And then a durable business is more like our swimming pool construction business, because if there's a dip, less people might buy swimming pools. But once we come out of the dip, we expect people to continue buying pools again, right? So that company's not going to get disrupted. It's not going to go away. And that's what we think about when we think about durability. So there's a lot of factors that go into valuation, but hopefully that helps kind of buyers and sellers think a little bit about how they should be thinking.
It really does help. And one of the things that you've just talked about, which a lot of people don't actually think through or just haven't heard before, is size does matter. The bigger the business, the higher the multiple typically, right? And so we often get smaller business owners saying, well, I want to achieve this because this is what my competition achieved. Well, the competition happens to be 10 times the size. So it's different, and the bigger the business, the higher the multiple typically, so long as both are equally healthy. Cody, anything that you and your team look for other than, of course, financial performance in assessing value?
We're in the same price range as Sieva, so 2 to 5x, pretty hard and fast on that. The other thing I would say is for people to ask themselves if you're selling or buying a job or a business. So a lot of the things that are listed are actually jobs, they're not businesses. And so, when you're going to buy a job, you're probably not even going to buy a job for 2 to 5x, because then you would be working for free for 2 to 5 years, right? And you don't want to do that. And so, I think a lot of the businesses that are, let's say, maybe below $1 million, but definitely below, let's call it 500K, 200K, at least in hard asset land, those are jobs. Those aren't, businesses. And they don't always have to be that way, but they typically are. Now in website land, you can get a lot more funky with it, and you can do stuff on the side, and it might not require as much, but I would ask yourself that question. And I think the second thing that we consider is, we'll pay more for platform acquisitions. So a lot of what we do right now, like the model that I put into effect in this time period where I'm semi-worried about a turn down, we call it BRRT, which is that you buy small businesses below 5 million in revenue that are in recession-resistant asset classes. Then you raise prices to deal with inflation in this environment as well, and you add technology to them. And so, in this environment, we're adding a lot of tech, and you can do this in almost every type of business. You can do it for websites where probably they have, I know James, some of the stuff he talked about in the beginning that I learned from him was like different affiliate sites, right? Or perhaps like in a content machine land, you have not very good lead pages and you need a better, CRM or backend or email management system. And the same thing is true in boring businesses. And so if you can go to a seller, if you can go to a buyer as a seller of a business who can have a platform acquisition out of your company, you can always sell for more. So that's why people sell more when they sell to strategics than when they sell to somebody normal. So a lot of times, like if somebody could sell me my 45th laundromat that's of the right scale in Texas to the fold who's already managing it, then yeah, it could pay a little bit more for that than somebody else. And same thing in media land, or for our car wash business where maybe sometimes we pay 5.5x or something because it's in a location that we want and we shut down a few others and consolidate them into one.
Thinking from a buyer's perspective, how do you actually stand out from the crowd right now?
Let me jump in really quickly because I gotta go run to get on a call about a deal. What I would say overall is, one, I think the reason why so many deals are crowded is because in most spaces, people haven't taken the time to figure out what their unfair advantage is to make deals that don't look good to everybody else look good to you. And so that's been one of the things that I've gotten lucky at is if we're all saying that we buy only on cash flow, that part is true. But we have these models behind it that show that we can do something different and we can value the company at something different than other people, but we don't always share that side of the coin. So like the really good buyers basically have this dark side that they're not sharing about how they can value a business different than somebody else. The second thing I would say that's like the most important in any of this is if you really understand what your buy box is. So like I buy X type of business at X size in this market, that does X, Y, Z. That allows you to make a lot faster decisions. It allows you to hopefully get financing a lot easier. And the fastest, cleanest, and usually closest to the market value bid is usually the one that's taken. And so I think time kills deals. And most of those 50 potential buyers are not very good buyers. They don't know their buy box. They're not fast enough. They don't have the financing set up. They screw around the owner too much. So they're going back and forth and it's not a good experience for them. And so if you can not be those guys, I think you close way more deals than you can handle typically. Damn
good tips. Round of applause for Cody. She's got to run to do a deal. So I'll continue on with Sieva and James for just a couple more minutes, but thank you so much, Cody.
It's not super competitive in the world that we're in. I think there's kind of two main categories of reasons for this. One is there are a lot of small service companies out there and it's not sexy, right? Everybody sees the software valuations. Everybody is familiar with online businesses, but getting into business around construction or home service, or even like B2B SaaS that we're in is sometimes a little intimidating, So it doesn't attract a ton of buyers, especially in the scale that we're in. Aside from that, we have a very clear message. I think this speaks to what Cody was saying about your buy box. If you go to our website or you follow us on Twitter, you know exactly what we stand for. You know exactly how we treat companies when we buy them. And those owners that care about their legacy, that care about what's going to happen to their customers and their employees are reaching out to us, right? They're not soliciting private equity to compete with us because they know that they don't want to sell it to somebody who's then going to resell it a few years later. They lose control of how their customers and how their employees are treated. And these are really important things for the owners, right? They've spent their whole life building these businesses. So it's totally reasonable that they feel that way. So I think maybe those are some of the reasons that we don't see a ton of competition.
Although I think that's a critical point. Sellers want to do a deal with someone who knows what they want, but is also empathetic to the journey that the seller or the business owner has been on for however long that journey is. And as we often say internally, you're actually making a moment. You might have been operating this business for 5 years. That exit, regardless of how small or big you perceive it to be yourself, for them is likely to be life-changing, and that needs to be respected. So establishing your buy box, communicating that accordingly, and then being empathetic to the journey is a really critical piece. Thank you for that. And James, any perspective you might have around how competitive the space is right now? Imagine for your newsletter subscribers and even for yourself, it's hyper competitive out there.
Ironically, I think that I am probably part of the problem here, right? In terms of buying niche content sites, right? I've got 13,000 people now that receive an email from me and 70,000 people on Twitter that follow me talk about it.
You're creating the competition, James. You got to stop.
Yeah, I know. I tell you, I just got an email 2 hours ago from someone I mean, again, I get this proprietary deal flow kind of often because of people know who I am, right? So really the best advice would be like, if you can become an authority in your space, people will sell you businesses directly just because they want to circumvent broker fees pretty often, right? But if you also don't have the ability to commit 3 hours a day to Twitter for 3 years straight, maybe maybe that's not the easiest advice. No, I think that, you know, the problem is that with the size businesses we're talking about with nano flips and I tweet about are much more commoditized, so to speak, right? I mean, they're really sort of like, it's just much more accessible to people. It is really why I think we've seen the valuations of these businesses be driven up over the past couple of years in a different way. I think that the reality is that no matter who you are, whether you are the niche website world is smallish, right? And so I think that for me, you know, when I'm a buyer, I bought a bunch of Instagram accounts 4 months ago. I flew to Montreal to go buy like 1.2 million follower Instagram network. Wow. And it was from a 17-year-old. I handed him a 6-figure check in a hotel room. He put on a suit. It was awesome. It definitely made it was the biggest thing. It was the biggest. I mean, it was the biggest, to your point. It was like the biggest moment of his life, right? Right. Like I literally gave him life-changing money at 17 years old or something. But my point is, when he was really dubious and scared, as he understandably, this stranger reached out to him through a DM and offered him, a lot of money for some Instagram accounts. He was very happy to buy it from me because he could find me online, and everything about me online shows you that I talk about buying and selling online businesses. Incredible. And so with that said, you don't have to have, CF and I both have pretty large followings in this little niche corner of talking about buying businesses online, but you don't have to be that person. But I would say that if you can have some sort of breadcrumbs to you that make you come across as like a legitimate buyer for these things, that you play in this space or that you work in this niche, I think that you are more likely to stand out as opposed to be just some random guy behind a computer screen, which I think is sort of what sort of worries people. And then if you can build enough authority, I think people want to sell me businesses because it sort of gives them access to, they know that we're going to do stuff together then, right? And there's like a lot more opportunity to come from it in the future for the niche site world, which is smaller. Obviously, people own like 10 niche sites and build them and sell them and build them and sell them. So it's about relationship building. And they know that once you build a relationship with me, you could probably just email me and I may buy it from you, or if you have a deal on Flippa, like I could probably email it out to everyone on my list and sell your website in an hour, right? And so I think that becomes pretty tantalizing for people to start building a relationship with me. So anyone, I think, though, can build those breadcrumbs that show that they know what they're talking about and that might be worth someone working with. At the barest of minimums, do you have a LinkedIn? Do you have a Twitter? Can I find who you are on the internet, right? Like one of the first due diligence checklist things I always tell people about is like, who's the seller, right? Like obviously you can be a no-name seller and have a very legitimate website that you're selling for sure. But, Joe Burrow, for example, right, is like one of the top brokers on Flippa, right? Like I know that when Joe lists something on Flippa, like it's probably a pretty legitimate deal, right? Yep. And so like there's something to be said about having some sort of reputation, or at least way to see that you're a legitimate human on the internet. I think that's an important thing.
I want to say thank you. It's been huge. It's been an hour of discussion about how to buy a business. Lots of wisdom. Sieva and James, Sieva from Enduring Ventures, James from NanoFlips, and of course we were joined by Cody from Contrarian Thinking. As part of this series, we'll obviously be sharing a lot about who these individuals are and why their insight is so very important. James and Sieva, thank you so much for being a part of Flippa Masterminds today.
Thanks, Blake. That was great.
Yeah, thanks for having us, man. Cheers.
Thanks a lot.